Hey there, everyone, and welcome to the Final Bar. It's Wednesday, April 3rd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the language of technical analysis. Technical analysis, I would argue, is one of the ideal ways, maybe the ideal way to quantify investor behavior. A lot of individual investors, a lot of institutions, a lot of money managers, a lot of people in different places are making buy and sell decisions, often based on their emotional state or the emotional state of their clients. At the end of the day, we can use charting and technical analysis tools to quantify that behavior, to identify shifts from fear to greed, from optimism to pessimism, from supply factors to demand factors. I would argue charts are a brilliant way of illustrating that. Are we in one of those rotational periods where one leadership group of growth stocks is taking a bit of a backseat to an emerging group of leadership names, things like materials and industrials and energy? I would argue very much so. Today's guest, Mish Schneider, is going to help us identify some of the areas where she's finding some potential upside in different parts of the market, actually, in renewable energy, in the commodity space, and more. With that in mind, let's take a look at how the market's played out through our market recap and focus on the charts and what happened today, and most importantly, how that connects to the big picture themes we've been discussing. Starting with the major equity averages, mixed results here, although to be honest with you, end of the day, not a huge directional move in either way. The Dow was down about 0.1%, the S&P finishing up 0.1% to 5211, we'll call it. The NASDAQ Composite up about 0.25% from yesterday's close. Mid caps and small caps all up and all outperformed the S&P. The S&P Small Cap 600 Index was up about 0.5%, and that's your best performer on the front page here of our dashboard. The VIX chopped around quite a bit earlier in the day, and this is similar to what we saw yesterday. Right out of the open, the VIX spiked above 15, so I'm getting a little sick of this alarm that goes off every morning with the VIX popping above 15, and then we end up closing below it. But that is, again, not a bad thing. That's just the definition of what's happening today. Getting a lot of choppiness, a lot of noise, and I would argue that is pretty standard for a rotational period that I would argue we're very much in the midst of. For the record, the VIX actually finishing the day around 1430. Again, earlier in the day, it was up about a full point higher, just almost to 1515, but finishing the day down below 15. So VIX above 15 is that sort of initial threshold, which for me tells me we're in a pullback phase. We have not had a close above 15 just yet. Here recently, so I'm holding my breath waiting for that particular signal. Not today. The 10-year yield, 5-year, and actually just the 10 and 5-year points moved slightly lower. The long bond yield actually remained relatively stable, right at 4.5%, just above there to 451. You see the 10-year yield around 436, 5-year point just slightly below that. The short end of the curve, of course, still remains fairly elevated. And the dollar index down about 0.5%. From yesterday's close. Higher dollar, I would say, is kind of a risk with this current market because there have been periods, for example, 2021 into 22, where a stronger dollar was a really bad sign for risk assets. We're not really seeing that play out just yet. Looking at the commodity space, a lot of green, particularly silver and copper, both up over 3% today. The SLV, which is a silver ETF, was up almost 4%. Gold, using the GLD, was up about 0.9%. Broader commodity space doing pretty well. Commodity-related sectors actually were at the top of our leaderboard, as we'll see in a few moments. Cryptocurrencies continuing to chop around quite a bit. Bitcoin actually rolling over here in the last 6 hours or so. Currently trading around 65,700. That's just up about 1/3% from yesterday. Ether prices right around 3,300. That's up 0.7%. You can see the remainder of the top coins that we track on our platform sort of mixed, and Bitcoin, of course, getting further and further away from that recent breakout. We got up to, let's call it the mid 70,000s, or getting nearer and nearer to that. Now we're back in the mid 60,000s, so it's certainly given back some of those previous gains. Looking at the 11 S&P sectors, you can see communication services actually had a nice late stage rally. For most of the day, it was the MEI stocks, materials, energy, and industrials, 1, 2, 3 at the top. Communication services kind of came in strong going into the close to take the leader position at 0.8% higher. Energy, materials both up about 0.6, 0.7%. On the downside, you have some defensive sectors, consumer staples down 1.1%, utilities down 0.4%, healthcare and financials essentially slightly lower from yesterday's close. So If you think about the offense versus defense that we often enjoy citing, which is consumer discretionary versus consumer staples, today just continuing to favor offense over defense. And I would say out of the defensive sectors, consumer staples probably the weakest of the three. That would be staples, utilities, and real estate. Staples have been the worst performer of that group, I would say, particularly on a relative basis. So offense over defense, still the rule of the day here, just looking at today's price action. Looking at what I call the Magnificent Seven and Friends, at some point I'll get around to changing that. I don't know if Fab Four is the name we're all going for here yet. That seems a little too timely for March Madness. I don't know if that one's going to stick. So actively looking for another way to refer to some of these leadership names, but I still think this is an important group to look at because it really shows how these stocks are starting to diverge a little bit. And you have some top performers like a Meta, like Netflix, pushing higher. Netflix, the top performer of this group, up another 2.6% today. Not quite breaking out, but very close to making a new high for the year. On the downside, you have Nvidia down 0.6%, Microsoft down 0.25% after that, Alphabet and Apple. Let's go to a daily chart of the S&P 500 and see, to be honest with you, I would say today's action sort of fitting into this range. Yesterday, we traded below 5,200. That's that green shaded area that I have on the chart here. The green horizontal line that is the dashed line here. 5,200 is my sort of initial line in the sand. We'll call it a tactical level to watch, and basically keyed in on that level because that was a nice breakout that we had third week in March. You can see we pulled back. That was that initial pullback after that big breakout of the range here. Was that low, and that closed right around 5,200. We then bounced higher to retest it. Yesterday, we have a bit of we'll call it a dragonfly doji, maybe a hammer candle. I don't know how you want to describe it. Depends on how you want to stretch your chart out. But basically, the open and close near the upper end of the range yesterday, but we traded below that level and closed back above. Today, we actually followed through to the upside. Now, it certainly looked around 3 p.m. Eastern. You had a pretty quick sell-off there in growth stocks. Rebounded nice going into the close. So we actually ended up about mid-range for the day. So for now, we're not closing below 5,200. So for me, that means don't worry, be happy about the markets. I like to think of any chart as innocent until proven guilty or guilty until proven innocent. And that tells you what's the primary trend you're observing and then what you would need to see to change it. I would describe this market as still innocent until proven guilty. What I mean by that is that we still have a pattern of higher highs and higher lows. Even this week, we are retesting that tactical low from last week. So that's right around 5,200. As long as we keep closing above that level, things are just choppy, noisy at worst, but not anything worse than that. We get below that level, I will immediately start talking about the 50-day moving average, 50-50, which I still think is a key level to hold. We break that, then we will start talking about much deeper and more painful drawdown potential for the S&P 500. Now, zooming out again, I think the concern I have with this chart of the S&P 500 is the same concern I have with the QQQ and many other leading growth stocks that have dominated returns in the last, we'll call it 4 or 5 months, really coming off of the October low. It's almost 6 months ago now, is the weakening momentum characteristics. The S&P 500, every time we've attempted to make new highs, has essentially come in with a lower RSI reading. Now we're trying to make new highs, and the RSI is not even getting to the overbought range. So that tells you, in my mind, weakening momentum, waning momentum, which usually tells us we're in the later stages of the uptrend, not the early stages of the uptrend, and that is what concerns me about this particular market environment. Looking quickly at the VIX, just to highlight, what are the warning signs when you have a market that's going up and when we're indeed innocent until proven guilty? What would it take to be proven guilty? And I would say it's things like high yield spreads widening out. You're seeing a bit of that, but not any dramatically negative sort of breakout on spreads. Volatility would spike higher, right? An influx of or an increase in volatility would suggest investors are getting anxious or certainly nervous. There's uncertainty, and elevated fear or uncertainty is the way I usually like to describe it. VIX over 15 would tell me, starting to show signs similar to previous pullback phases. I think if you look back here in June and July of last year, we saw the VIX pop up to 15 a little bit during this uptrend, but it was when the VIX finally popped above 15 that told you, okay, maybe this is the beginning of something a little more significant. Ended up being obviously about a 3-month drawdown to the low last week in October before the rally coming out of Halloween and through the end of this year, end of last year, that is, and really continued through the last 3 months, right? Q1 just following in on on that uptrend. The VIX has noticeably not really pushed above 15 in any meaningful way, and that's the move I would be looking for here. That, for me, would be a big-time red flag. We have not seen that red flag just yet. Now, let's talk a little bit about sector leadership and some of the areas where we've observed strength and potential weakness. I just want to point out that we talk about momentum divergences. We talk about charts that feel long in the tooth, meaning they've had a really good run, and you start to question the longevity or the sustainability of those uptrends. But even with that in mind, I would point out that in a sector like technology, probably the growthiest of the growthies, and if you look Western Digital, which is one of the hard drive manufacturers, WDC and STX, Seagate would be the two that come to mind here, continuing to break out, right? Making a new 52-week closing high today. So even though we're seeing some concerns underneath the hood, even though I would say there's a general rotation from growth leadership, sort of the previous leadership, to now more value leadership like materials and energy and industrials, there are still technology stocks going higher. And as much as I generalize about particular sectors and leadership themes, these are generalities. I mean, I could point out consumer staple stocks that look pretty good, and I can point out utilities names that are breaking to new 52-week highs, and I can point out leadership sectors like energy, and there are stocks making new 3-month lows today. So remember, all sectors are not perfectly homogenous, meaning there are opportunities in all 11 sectors pretty much at most times, regardless of the cycle. So focusing on charts that are working, I would say it's always a good time to own good charts. So something like WDC, if it's a good chart, I wouldn't worry about the fact that it's in technology and whether you think higher interest rates might hurt or help this particular stock, or what it means that other technology stocks are struggling. If it's a good chart, it's a good chart, regardless of what the ticker is. So charts like WDC, I think, are still quite strong. Is it maybe due for a pullback because we're overbought a bit? Potentially. But do we keep making higher lows above an ascending 50-day moving average? We do indeed. And that is the mark of a strong chart in a strong uptrend. So keep in mind that even in a sector like technology, arguably getting to the end of its performance run, we're seeing some opportunities. The chart of the XLK kind of tells you the bigger picture. So while WDC is breaking to a new 52-week high today, you can see that the technology sector is not. March was actually a flat month for the XLK, right? We finished the month slightly lower than where we started. And so far here in April, we're bouncing off an ascending 50-day moving average. So the bull case for technology is that this is yet another test like we saw in January and like we saw in February. I think the bear case for technology is that the momentum is even. We're at an equilibrium, and the problem is, as other sectors are thriving, technology is actually underperforming. So if you've owned the XLK for the last 8 to 10 weeks, you've actually underperformed the S&P during that period with that position in the XLK, and that tells you a lot about the rotational, I guess, environment where we're sort of seeing assets rotate away from these stocks into other areas of the market that are showing renewed strength. Let's talk a little bit about airlines. Just poking around with some of the stocks that I'm seeing, bouncing higher and bouncing lower. Airlines actually getting dinged a bit here today, although again, going into the close, things changed a little bit. JetBlue Airways is one I wanted to highlight. Showing the candle chart, this is one of those doji candles that we've highlighted. I'd probably call this a dragonfly doji, which is where the open and close are almost identical. We have a limited upper shadow and a long lower shadow. So again, think about what happened. The last couple of days we've been trading lower. We actually gapped lower yesterday. We gapped again, not quite a gap, but we opened a little bit lower around 685. At some point, we traded down to around 665 or so, but by the close, we got back up to the highs of the day. So overall, suggests a short-term bounce, but look at the chart of JetBlue and how we've been testing resistance. I think the concern for a stock like this, and why I tend to avoid something like this until proven otherwise, is we're basically showing that resistance around 750 is pretty good. And what I mean by pretty good is it's a very consistent level, right? We first hit 750 in February. We pulled back to around 6.25. We retested that level in early March. We've now retested that a third time here in late March, and now we've pulled back yet again. So while the short-term, the candle pattern is short-term bullish, and you've had things like a bullish engulfing pattern, we've really not been able to follow through above 750. So this is one of those charts where I like to be patient and wait for that breakout. You'll see an example with Mish Schneider, our guest today. I think one of the charts we're going to look at, uranium stocks have already broken above that resistance. That's the type of breakout that I would be patient for. I think JetBlue is an example of a chart that just really hasn't broken out quite yet. Southwest is another one, and I think the challenge with a chart like Southwest Airlines is it looked really good in mid-February, sort of that innocent until proven guilty look where we're making higher highs and higher lows, and it felt like this was going to be another higher low before a breakout. Then we had the gap, right? And the gap followed by additional selling. Right now, we're actually testing the low end of that range that we've established after that gap. Most recently, we've traded up to an ascending 200-day moving average and now failed to get above there yesterday and now today, finishing at the lows of the day. So airlines had been really in an interesting position January into February. And really at the end of February, you had a lot of these charts that were actually setting up with pretty constructive moves. You know, Alaska is maybe one of those, an outlier of sorts, breaking above the 200-day moving average. But even that one gapping lower here this week. So maybe a vulnerable space. And the question is always, do we make higher lows? Do we, resolve to the upside? And I'll be looking for breakouts on charts like JetBlue to see if we can gain some ground above those previous highs. Speaking of stocks gaining ground above previous highs, let's talk about gold miners, the GDX. As I was scanning for stocks making new 3-month highs, that's part of my normal weekly process for my market misbehavior premium members. And I sent a note out earlier today, actually, that is highlighting some of the stocks making new swing highs. A lot of gold, and it's the GDX that we're highlighting here is a pretty liquid gold miner ETF. So GLD is more of a play on physical gold. GDX would be the gold miners or gold stocks. Look at the resistance in July of last year and December of last year, right around 32. We've now just broken above that level here today. And names that would come to mind, they were all on the 3-month highs list. Agnico, AG, what's another one? RGLD. Royal Gold, in this case, kind of testing resistance, not quite breaking out, but sort of right in the ballpark of there. Kinross Gold, KGC is another one making a new 52-week closing high today, getting above there. Newmont Mining is probably the largest of this group, about a $43 billion market cap. This is arguably probably the least attractive of the bunch because it's still below a downward sloping 200-day moving average. And previous tests of that same level in July of last year and December of last year failed. And that ended up being the end of those counter trend rallies before rotation lower. But when I'm looking at the GDX and arguably almost any other gold stock, I'm seeing renewed strength here, and I'm seeing a new swing high. So I scanned for ETFs making new swing highs. This is where some of the gold ETFs started to come up, particularly the gold miners. So I keep an eye on that space. If you've been underweight gold, if you've not been looking at them, certainly some opportunities. Materials came up in my conversation, I think that was yesterday with Joe Rabel, where we talked about some of the materials sector as a whole. And as I'm scanning for stocks making new swing highs, I'm seeing things like our Alcoa, which is an aluminum play. STLD would be Steel Dynamics. This is obviously a steel company. Let's see, Reliance is another one to think about. RS. These are stocks at or near new highs, really rotating higher, and the improvement in relative strength, I think, is what's most attractive of this particular sector and this particular group of stocks. Folks, that's our market recap. Again, these rotational elements that we talked about, I think, we've continued to find new examples to highlight those. So hopefully that's helping you recognize this potential rotation here from growth to value leadership. We have a great guest today, Mish Schneider, who we'll bring on here in a few moments. Before we do, just a couple quick announcements. First off, our mailbag is running low, and we would love to hear from you. What questions are you running into as you are analyzing your own charts using our Stockcharts platform? Let us know. Email is best, thefinalbar@stockcharts.com. And thanks so much to those of you that have sent questions with a permalink, right? The link below the chart that helps us see exactly what you're looking at. Super easy to answer your questions. Also here on YouTube, of course, just drop a comment below the video that you're watching. We'll look forward to incorporating your questions in our next mailbag episode. Also, I'll be speaking at the Money Show Investment Masters Symposium. This is a really cool gathering. I think the Money Show just started this new design for some of their events last year. I attended one in Las Vegas. It was really cool, a nice sort of smaller, intimate group, some really thoughtful presenters, and some really interactive discussions, which I appreciated so much. And I enjoyed it so much, I'm doing them again this year. This is May 7th through 9th. It's located in Silicon Valley, California. If you can get there in person, we'll look forward to meeting you. And if you do, please make sure you say hello and let me know that you're watching the show. I would love to connect with you. I'll be doing a workshop and also a 2-hour masterclass called 7 Questions to Ask Before Every Trade. To sign up for that event, you can scan the QR code on the screen or click the link in the description. And hope to see you at the Money Show Symposium in the Silicon Valley, May 7th through 9th. I want to welcome on today's guest, Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us from Santa Fe, New Mexico. In the new digs down there, Mish, which look fantastic. Good to have you back on the show. How are you as we kick off Q2 here?
I'm very happy right now because making money has been relatively easy, especially in the commodities world. Number one. Two, the weather is gorgeous. And number three, it's your birthday.
You're kind to celebrate all three of those things, and I would agree. All good news around there. You mentioned, I mean, commodities. We'll talk about a number of things. I mean, credit to you earlier this year when you and I have spoken as part of our market outlooks, and in other words, you've often mentioned of strength in commodities. It's really starting to materialize here. So congrats on that. I think that was well played by you. We have a series of charts that really highlight, I think, some of your proprietary indicators that we have on the Stockcharts platform, but really talk about some opportunities in a couple different areas. We'll start with the currency market. We're looking at the Swiss franc. This is using an ETF called FXF, and we're starting with your weekly chart. Talk us through what you're seeing here.
Well, and by the way, if you want to trade it through a futures, it's CHF, just mentioning. And I always look at the underlying before I make a decision on buying an ETF. And of course, there's always issues. One is not necessarily always pure, but in this case, what's so fascinating is this whole obsession, and I can call it kind of an obsession that I've had with Swiss franc because I've been writing about it and tweeting about it, came on the fact that in the middle of the night, I heard Swiss francs. And not that that's a trading strategy, of course, but it's certainly a heads up to look at a chart when something like that happens. Well, I have no idea why my brain would have done that, but it did. And when I looked at it, I happened to look at it. What we're looking right now is at the weekly chart. When I looked at it, it was 2 weeks ago. So it was coming down sharp from the 50-week moving average, which is the blue. And during that period of time, the volume, which is about 30,000 a day on average, went up to 150 to 200,000 traded. And Dave, I know you know better than most that when you have that kind of volume on a descension or even ascension, it's often a blow off. Yeah. So that got me thinking, okay, time to look for a blow off bottom. And lo and behold, the next week we got more follow through. And as we've started this week, we're holding that 200-week moving average perfectly. So that means two things. Number one is you have a great risk point, and we're going to talk about the daily and why we're looking for a good risk point. And number two is if you go back to October, the last time we were down at these levels, almost the same thing happened. You had this massive descension. It broke at that point, the 50 and the 200 weeks were closer together. But nonetheless, we tested it. We came back, we held it again. We crossed the 50-week moving average the following week. And then we had this incredible rally. I mean, that's a nice run if you're going to catch a run in something. So let's take a look at the daily chart because it pinpoints it just a little more. Okay. So, I mean, you can see right here that in terms of the calendar ranges, we're way below. In terms of the moving averages, it almost looks like we're about to head into a death cross, but I don't worry about that too much when the price is so far away. What's more interesting to me is that we made a new low today on this move, and then we closed on the highs. That's a classic, whether you want to call it a glass bottom or a ceiling or a reversal bottom, however people like to define it. That is classic. However, it does need confirmation. And so the confirmation would be tomorrow, really. And that it would be is if it closes over the high of today, which I think was like 98.54, or gaps higher, then you have that risk to what we showed you, that 200-week moving average in the low of today. And the other thing is if we go down to the real motion indicator all the way on the bottom, you can see we had a mean reversion today too. So that's happening at the same time. So you need the price confirmation when you have the momentum change and you see a divergence like that. Just from a fundamental standpoint, real quick, what's interesting about this, besides that big spike in volume, is that the Swiss actually lowered their interest rates. And that's one of the reasons why the Swiss franc went down, just like, the yen, even though they raised, the yen didn't do it enough and the yen free fell, much to the Japanese surprise. But in this case, it actually followed in kind. And so if this means that we're going to see any kind of loosening of monetary policy, and the Swiss are any kind of example, this could be not only an indication of higher for this, lower for the dollar, but even another maybe nail in the coffin of why all of a sudden people should be much more concerned, as we've been sort of predicting, on a potential super cycle of commodities.
Really, really interesting. And a nice, from a technical perspective, really nice illustration of the multiple timeframes, the weekly and finding that support. Then looking at the dailies, more the tactical read. I like that very much, Mish. Let's get to some other areas of the market. Solar stocks have been, I mean, noticeably range bound. What do you see when you're looking at the charts today?
Well, this is another area that has been, it was so popular a few years ago, solar energy, and then all of a sudden, especially over the last year, it's been more of the focus on oil and gas, and of course, just energy stocks in general. And so it has interested me that this has gotten so beat up that, again, I started trying to see, where would I get into this? And is this a really good opportunity to catch something that I believe will start to trend higher, particularly as we get closer to the election, and definitely probably would have even a bigger move depending on who wins the election. Obviously, a Democratic nominee and a Democratic election would possibly be stronger for solar, although it hasn't worked out that way as many pundits would have guessed. But nonetheless, getting to the chart right here, what interests me again on this is we have another bullish divergence, just like I showed you, except a little different. If we go down to the real motion, look at the moving averages. They are below the momentum, and yet on the price, we are below the moving averages. That blue line there is the 50-day. The one above that is the 200-day, the green one all the way up. And then if you see that red horizontal line, that's our January 6-month calendar range low. And it's been all over it. But what makes this really interesting to me right now is the bullish divergence, which we've seen before, is the fact that it's gaining some ground against the SPY in terms of the leadership. And if we get two closes, I think, over the 50 and the 6-month calendar range, which is about 44.22, then it confirms the bullish divergence, again, with a very low risk. If you want to hold on to this as we would plan to, then we would probably just take a risk down to under 40, thinking that this could easily work its way up at least to 50, and then we can reevaluate.
It's so interesting, the gap, I think, performance gap between sort of old energy and new energy. Nice sort of playbook on what we might want to see solar stocks reemerge. The last chart to look at, uranium. Uranium really has started to accelerate to the upside here beginning Q2. What do you see on this chart?
Well, again, and yes, I mean, I know Dave and I talked a little bit about this before. I didn't bring gold and silver and copper and all the things that I've talked about for the last couple of years, and all of that is happening. And I felt at this point, let's look at something different, but commodity related and also geopolitically related, because clearly there's been more talk about nuclear energy, number one. But with Iran in the conversation now, with Israel, we have to look at uranium, right? So there's your fundamental reason. From a technical standpoint, we cleared that 50-day moving average and look at how classic. Let's just go down to that real motion, because this is what we were talking about with TAN. We got the bullish divergence when the momentum cleared the moving averages. Just at the same time, we started to get the bullish, well, I shouldn't say a bullish, because that's not a bullish phase, but it's the same time we got a move over the 50-day moving average. Actually, that is the bullish phase, because we can't see the 200 there. Also, look at how nicely it held the calendar range low, that January red horizontal line on the bottom, so it found that support. And also look at now where the rubber meets the road. If this is going to continue, that green line above, horizontal all the way, is the 6-month calendar range high.
Right.
If you look at silver, we've cleared it. If you looked at GDX, we've cleared it. If you looked at oil, we cleared it ages ago. And if you look at a lot of the stocks, we've cleared it. If you really want to see whether or not uranium, this is just being dragged up with all the other commodities and some geopolitical talk, or if this is really a trend that's going to continue, I would see that have to clearing the 6-month calendar range high, number one. Number two is the February high was 32.60. And number three is you really have to go back to 2013 to see levels beyond 32.60. 11 years ago was the last time uranium made some kind of an explosive move. And that's the kind of stuff that gets me really excited. And when something has been so dormant, but yet it's a raw material and yet is in a conversation, that could be another real parabolic move. And not such great consequences, of course, on the other side of it.
For sure. Thanks for highlighting uranium. You were agreed early on with the commodity rally that we've seen. We've seen it really continue to emerge in energy, in precious metals, and elsewhere. We only have about 30 seconds left, Mish. As we kick off Q2, when you look at the broader equity environment, do you find yourself more optimistic, more cautious? What are sort of your general things to keep in mind as we're navigating the beginning of April here?
I'm still relatively optimistic. I just think what people have to understand now is you don't really want to be involved in companies that are going to be highly interest rate sensitive. We've heard a lot of Fed speak, and it doesn't look like rate cuts, even though people think they have to cut because of the interest rate payments that they have on our huge debt. Regardless if they cut or not, anything in this level of interest rates, companies that can handle and don't have earnings growth, I would avoid. But it leaves it open for so many other companies that we've seen done well in large tech, in large cap and tech stocks, but also in some of the small and the mid cap stocks. There are some stocks in that area that I think can really explode, especially if the earnings season turns out to be as good as a lot of people expect.
Yeah, earnings season just around the corner here as we kick it off. It'll be interesting to see what sort of catalyst that provides for risk assets. Mish, always a pleasure to see you. Thanks so much for sharing some charts and some insights with us. Stay well and be well down there in New Mexico. And thanks for the birthday wishes. Super kind.
Well, happy birthday.
Take care, Mish. That's Mish Schneider. Mish is the chief strategist at MarketGauge. Really interesting, and I like that the first set of charts looking at the Swiss franc. If you caught what we did there, it was looking at the weekly chart to identify some longer-term levels, and then focusing on the daily chart is more of a tactical read about how we trade around those levels. And I would wholeheartedly agree with Mish's comment there with something like currency ETFs with commodity ETFs. I think analyzing the underlying as much as you can be very valuable. Think of the ETFs as ways that you can add or gain exposure to those spaces, but a really nice illustration of using some of those proprietary tools from the MarketGauge folks down in Santa Fe. So check it out on ACP. The bottom right corner has a little plug icon. That's the way you can get more information on the MarketGauge plugins for Stockcharts ACP. Got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So a little different idea today with the 3 in 3, actually, because we're highlighting 3 sets of relative charts. Relative strength is basically the idea of looking at a sector or ETF or stock relative to a benchmark. So all of these charts I'm about to show you have a set of sector ETFs relative to the S&P, and I'm grouping them into 3. So we're going to start with the growth leaderships. When we talk about this rotational environment, I hope these 3 charts tell a pretty decent story about what we've been observing here in the last 6 to 8 weeks. So we're starting with technology in the top panel, communication services in the middle, consumer discretionary in the bottom. These are 3 very different profiles, I would say, particularly when you look at the last 3 months, right? Look at the first quarter, and now what's happening at the beginning of April. Arguably, communication services in the middle, the strongest of the bunch, in that the relative strength is improving or improved in the month of March. April starting off with some strength. Alphabet, probably out of that Magnificent Seven group, arguably the best of that, I would say, if I was ranking them in terms of their recent performance. Alphabet has done quite well at or near new all-time highs as we speak, and so the relative performance of communication services looking pretty good. Technology, not as good, right? And if you look at February, March, you can see the XLK has been sloping downwards, again, on a relative basis. So what that means is if you bought technology in mid-January and you're sitting on that now, you've underperformed the S&P during that period, which it does not feel particularly good, I would imagine. The XLY, which is consumer discretionary, has really been in a relative downtrend since mid-December. Now, that's obviously been dragged down in a not so small a way by Tesla's struggling and really diverging from the rest of the Magnificent Seven stocks. But overall, a lot of the growth leadership, particularly technology and consumer discretionary, really lagging behind the market here to start off 2024. And that's the environment I think we find ourselves in as we kick off Q2. And as my guest today, Mish Schneider, mentioned, earnings season kicking off here in the next couple weeks. I think a lot to prove on some of these growth sectors that are starting to lag behind the market. Now, if those are lagging behind the market, what is starting to outperform? I present to you your next 4 sectors, which are all what I would call the value sectors: industrials, financials, materials, and energy. Look at the relative strength lines that are sloping higher on all 4 of these. So as I was talking earlier this week with Joe Rabel talking about materials and energy, as I'm talking with Mish Schneider today about uranium, these are the types of names that are all included in these 4 sectors. These are more value plays. Less growthy companies, less looking for exploding or expanding earnings growth. These are more value-oriented plays, stocks that you identify as undervalued and hopefully can ride and see that those valuations start to improve. And we're seeing that. We're seeing that based on the absolute returns that you saw in the first quarter from some of these value sectors, but especially in the last 6 to 8 weeks, where all 4 of these relative lines are making new swing highs here to kick off Q2. So this is where the opportunities have not been in 2023, generally speaking, but this is where you're really starting to see outperformance as we begin the second quarter. That leaves us with this final group, and I eliminated healthcare because healthcare is kind of a weird mishmash, but I think 3 pure defensive plays: utilities, consumer staples, and real estate, top to bottom. Now, all 3 of these have been struggling in the last 12 months. All 3 of them made new relative lows in the first quarter. One of these utilities is maybe threatening to break out. And when I think about an improvement in defensive sectors as a sign of a major market top, this is where I'm really not seeing that materialize too much yet. Consumer staples are making a new relative low, real estate making a new relative low. If I saw an improvement in those relative performance lines, I would be a little more cautious about the broader market environment. You are seeing utilities improve, and I'm seeing some utility stocks with some decent setups, but overall, it's still value over growth and value over defense. Keep an eye on these relative trends to identify a change in leadership. I think we're seeing that here as we begin Q2. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Mish Schneider of MarketGauge joining us from New Mexico. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.